We want to bring in Tom Graff. He's the head of fixed income at Brown Advisory. And Tom, I hope you were just listening to what Brian was just saying, just recapping what we've heard from Fed Chair Jay Powell over the past hour. Just let me get first your reaction to that. Not only that, but then also the reaction that we're seeing, or lack thereof, I guess, in the bond market today.
Well, yeah, thanks for having me. Well, really, the bond market has taken this pretty dovishly if you look at the shorter term part of the yield curve, which is most influenced by the Fed. The 3- and 5-year Treasury are both 5 basis points lower, and they were about unchanged prior to the Fed coming on. Also, if you look at other things like the dollar, that's weaker. So definitely the market has taken this as a pretty dovish statement. And I think some of the things Brian was saying is part of why that Powell didn't shrink from saying, more stimulus would be great. He also really pushed back hard on the idea that tapering was anywhere near, or even that they needed to worry about long-term interest rates rising. All that was sort of taken as pretty dovish by the market.
Tom, great to see you here. I want to follow up on what seemed to be the elephant in the room addressed early, and that was a question about the supplemental leverage ratio that Powell refused to answer. He just said, ask another question, which was kind of funny. I know this really gets into the weeds. I saw a note earlier from Credit Suisse's Zoltan Pozar. He was the architect of the 2008 emergency facilities. He knows about this step. He says the SLR doesn't matter, does it?
I think in the short term, it probably doesn't matter. I would agree with Pozar. I think that few banks were using it from what we heard, and then also from his own research. So I'm not too worried about the SLR. I think what would be really helpful is if there could be more sort of longer term reform on how market making works, especially in the Treasury market. So I think, this sort of short-term Band-Aid isn't necessary right this moment, but I think a longer-term solution, hopefully, is what the Fed's working on.
Tom, when we talk about rate hikes here and the fact that we likely won't see one, at least at this point through 2023, is there a risk at all for the Fed in waiting too long to raise rates? And I guess, how are you looking at that?
Well, sure. Look, I think the reality is, and I hope Powell would admit this if asked, is that we don't really know what causes inflation, and we don't know whether kind of easy money through this robust a recovery could spurn inflation in a way that we haven't seen in these last 3 decades. He's been favoring sort of referencing the lack of inflation for the last 30 years, but we've never really had this exact combination of effects at once. So it certainly could be a risk. But Sean, I think we know how to arrest inflation once it gets going. We don't know how to spur inflation. So I'd much rather the Fed err on the side of waiting a bit too long, and it appears that's probably what they're going to do. Then worry about kind of arresting that nascent inflation too early.
But Tom, we only got about a minute and a half here to go. I want to ask you about the bond market in general. Bank of America was out with a statement with Global Fund Manager Survey yesterday saying that 2.0% in the 10-year is a critical threshold that bonds need to reach only to have equities correct 10%. So are there some magic levels in your work at play here where it's just too much or too fast for the markets to handle?
Well, so that's an interesting question because, for my whole career, I would always have said higher interest rates is probably good for stocks because it means the economy is good and earnings will be growing. And right now, we're at an unusual point where interest rates are probably influencing valuations in risk assets in a different way than is common. In other words, I don't know that earnings can keep up with how interest rates may be influencing valuation. So it's a pretty unusual situation. I'm not sure that where the 10-year goes is the magic thing. If you look at today's market move where you saw sort of growth stocks catch up, you said in your chart that sort of the S&P was late to the party, Jared, that I think you saw the growth stocks sort of catch up with value stocks as the day went on. I think that's because shorter term interest rates fell. I think they're really focused on how quickly the Fed might start hiking. So I'm not sure it's like a magic number on the 10-year so much as it is just policy generally.